Hi, everyone. Thank you for coming to lecture 6. So the entire first half of the course was pretty technical. And then from here on out, we're going to start getting into more like general, broader applications. So hopefully it's a little more interesting. But yeah, all right. So a quick agenda for today. We're going to start off with regulation. We're going to talk about reasons for regulation and the securities debate. Then we're going to go into some case studies that I think are pretty interesting. And then finally, we're going to go into some proposed legislation from around the world. And then the second half, we're going to have Mateo speak about tokenomics, like key metrics, allocation and distribution. We're going to talk about vesting, utility, and then finally another case study relating to one of the case studies that we'll talk about in regulation. Alrighty, cool. So we'll talk about the regulation debate first. This is just a bit of history. I'm sure most of you guys are familiar with it. Within the United States, at least a lot of times, the goal for regulation is one, to balance consumer protection, but also to foster innovation. So there's at least within the US, one side is to protect consumers, prevent fraud, ensure stability, all the roles that a central government should take. But the other side is to foster innovation and not kind of hinder that with regulation. Cool. And so throughout history, there's been this inevitable pattern, at least when it comes to new technologies, about the government wants to regulate it, make sure it's being used correctly. And this can apply to physical technologies like the railroads and anything like that. But also what we're going to be talking about today, it also applies to digital technologies like the internet and Web 2. But one issue that we have with regulation is that the legal system does take time and it usually lags behind. I think it didn't work before. Yeah. Okay, cool. So now we're going to talk about Web3 regulation. So the entire debate is between regulation and decentralization. So if we want to start again with Bitcoin, which was the original blockchain, it was created for operating away from banks and central government. So essentially the whole goal of it was to be decentralized. But in the present, now there's a spectrum depending on what blockchain you're using. So it can go from anywhere from very decentralized to, a little bit more centralized. And Ethereum is a good example. Ethereum versus Bitcoin. Bitcoin is fully decentralized. Ethereum has some sort of at least central figure, which we see in Vitalik. So yeah, overall, there's pretty much just a balancing act between maintaining the decentralized nature of Web3 and blockchain while protecting citizens from fraud, which we'll get into a little bit later with the case studies. Okay. Cool. Okay, so we'll start off with the securities debate. So to define securities, they're pretty much just fungible, tradable financial assets. And the debate is pretty much between the proponents and opponents, like any debate. So the proponents for labeling crypto as a security say that cryptos should be subject to laws and regulations because they share very similar characteristics to securities that we see today, like stocks. And that's again listed there. Specifically, past token offerings and initial coin offerings resemble traditional securities offerings. And so that's why a lot of proponents say, or that's a piece of evidence that a lot of proponents point to when they argue that crypto should be labeled as a security. And the opponents say that crypto does have unique traits. One, the main thing being that it's very decentralized and they're digital tokens and they're utility tokens instead of just investment contracts like stocks are. All right, so in the past, literally just 5 years ago, the Securities and Exchange Commission said that, crypto is not a security, but we want to note that views do fluctuate. So nowadays, 5 years later, Gary Gensler, who's the chairman of the SEC now, is really all for investor protection. So he says that, to some degree, crypto should be regulated. And he kind of changed his, so instead of the securities debate, now, Gary Gensler says that, maybe it'll be a commodity instead. So instead of a tradable financial asset, it's just a tangible or a tradable good. So he argues that Bitcoin and Ethereum are commodities. So the point of this whole securities debate, few slides, is just to mention how it's still a very new market. The views change pretty much yearly. So it fluctuates and there's not really much regulation, but there is debate over, what to label crypto as. And of course, like what depending on what you label crypto as, the regulation might change a bit depending on that. Okay, we're gonna get into 3 case studies. We're gonna start with the Silk Road in 2011. So this is one example of where regulation could potentially have been very beneficial in preventing, illegal activities. So what is the Silk Road? It was essentially a black market platform that operated on the dark web, and they used Bitcoin because like it was pseudonymous. You couldn't really trace back, who was in charge and who owned that Bitcoin. So that was very useful for the people who wanted to buy, drugs or like do any sort of illicit activities on the black market, in this case, Silk Road. And we do want to note that crypto is a digital asset, so it's not inherently designed for illegal activities, although it can be used for it, in this case, Silk Road. So this is one case where, regulation could have prevented a black market developing and the use of Bitcoin. It did end up leading to Bitcoin having like a bit of a negative connotation, at least in the early 2010s, just because it was being used for illegal activities. Okay. 2016, the Ethereum hack, maybe some of you guys have heard of this before, but what happened was that there was an issue with one of the DAO's smart contracts, not really with the blockchain or the native coin, but really for the smart contract that lived on top of the chain. And so that resulted in just $8 million, $8 million being lost pretty much per hour. So the consequence was that Ethereum forked into 2 chains, Ethereum Classic and Ethereum, which essentially means that Ethereum Classic kind of just lived on and continued like with the data of the hack like being maintained in the history of transactions. Okay, and Ethereum Classic basically just lived on. And it didn't, hide any of the data about the transaction, about the hack happening, whereas Ethereum kind of just reverted back to the transactions that happened before the hack. So it just continued on from before the hack happened, and it just pretty much kind of ignored the hack. So now there's 2 chains living on pretty much. Some people say Ethereum Classic is the chain you should go with, but nowadays a lot of people still stick with this Ethereum chain, which pretty much just means that you just pretended like the hack didn't happen.
I'd use this one.
Okay. Thanks. Okay, so the final case study that we're going to look at is the case of FTX, which I think many of you guys may have heard of. It made the news last year when it happened. Sam Bankman-Fried, I think is how you say his last name. But he was pretty much in charge of this whole thing. So we do want to note that FTX was decentralized by name, but structurally centralized. So it means that internally it was centralized. There was centralized governance and all that, but outwardly it was decentralized. So essentially it was centralized by name, but decentralized in the name of crypto assets. And so essentially what happened was that there was this hack and it led to kind of just exposure of what happened, which was that there was mishandled funds behind the scenes and the negligence of assets. And so some of these red flags where regulation could have come in handy was that, one, there was a lack of governance and lack of disclosure of funds. So there were a lot of red flags that we could have seen, especially from the tokenomics point of view, which Mateo will talk about later. But in terms of regulation, there were a lot of red flags that could have been seen from miles away, but nothing was done because of the whole debate. And because of that, like millions of people were pretty much impacted and lost money. Cool. So there's been some proposed legislation, although not like any tangible one that I know of. So in the UK, EU, and New York, the state of New York, they've actually defined what a virtual currency or current activity is. But for example, in China, Japan, they pretty much just banned the use of crypto. And they're like, okay, crypto is not covered by regulations. But if we want to look at the US federal government, there's been an executive order that Biden released last year, and it's called the Executive Order on Ensuring Responsible Development of Digital Assets. So essentially, he listed out strategies for encouraging responsible innovation, for mitigating harmful activities, and to detect cyber weaknesses, among like many other things that he wanted to cover. But again, that was an executive order, so it's not fully like a piece of legislation. It's just, he's like, okay, here's some strategies you could take, but it's not really enforced on the industry. So again, I want to mention that it is a complex balancing act in terms, like for regulating Web3, it is a complex balancing act between maintaining decentralization, but also making sure there's no illegal activities like we had on the Silk Road. No, like we know what to do in case of a hack. And then finally, you protect consumers in case of FTX again. All right, so now Mateo's going to talk about tokenomics.
Cool. Yeah. So thank you for that first part. I'll just go on to talk about like what tokenomics is first of all. So imagine you have like two people like Alice and Bob, and Alice is really invested in crypto, and Bob does not really know anything about crypto. When Bob looks like at the display, they might immediately look at like the number or the price of Ethereum, for example, and just stop at that, right? But Alice, being more invested in cryptocurrencies, they might look at the other values like circulating supply, total supply, market cap, and so on and so forth, right? And so when it comes to evaluating which cryptocurrencies to invest in, these tokenomics are really important, right? So obviously the first one, which is circulating supply, is really important, right? So it's just the number of issued tokens in circulation. Pretty simple, right? So here you can have 120 million Ethereum, right? And then you also have the total supply. So this is including tokens that have been created and then burnt. This can be burnt for many different reasons, but usually it's as part of a contract or something like that. It's a little bit less than, or sometimes the total supply can be a lot greater than the circulating supply, depending on the tokenomics of the coin. And then there's also the maximum supply. So when it comes to Bitcoin, for example, there's a theoretical maximum supply of Bitcoin that can ever be in circulation. And this is governed by how the coin works, like how the code of the coin works. Ethereum does not have a maximum supply, but it has a max issuance per year. So for example, Bitcoin has a max of 21 million. NFTs take this to the extreme. So for example, the Bored Ape Yacht Club has a maximum of 10,000 tokens at most. So that adds the rarity of this NFT, non-fungible token. And other projects might have just a single token for one piece of art. And so when you look at like the maximum supply of things, you can sort of get a sense of like whether there's going to be a deflationary aspect to this coin in the long term. So, okay. Also, another thing is market cap. So market cap is just simply multiplying the market price with the circulating supply. And so this is really important. Investors will use this along with the circulating supply, the market cap, and also, or I just said market cap, but other tokenomics to like figure out, how much inherent value does this coin have? Other parameters include vesting schedules, stuff like that, which we'll talk about in just a bit. And so, for example, one thing you could do is say, like, if you have like really low circulating supply, and then you have really high market cap, right? That means that the individual coin is going to be worth a lot, and so you'll have high selling pressure, especially when there's going to be lots of again, I'll talk about it in the future, but if there's like a really aggressive vesting schedule of new coins added in the future. Okay, and this is just called FDV, or fully diluted market cap. And this is just basically saying the maximum supply of coins possible multiplied by the coin's price. So in each of these slides, I'm giving an example of Ethereum. So you can see that Ethereum has that much FDV compared to the market cap. And so it's pretty similar, basically. Like the idea is that FDV and market cap should be pretty similar. And it doesn't indicate. So the thing with market cap is that it doesn't always indicate the crypto's growth and how it will affect its popularity. FDV, however, gives you an estimate of how popular the crypto will be once all the coins have been released. So, the idea is that FDV and crypto market cap should be ideally really similar. And if they aren't, that's kind of a problem, because that means that there's a sign that there's an overinflated current price. Basically, that there will be high, inflationary pressure when there is such a difference of FDV and market cap. And then that's just the metrics. Beyond that, there's the allocation and distribution. So there's 4 different ways that like tokens can be allocated. I've been kind of like lax with how I say token and coin. Tokens and coins are actually somewhat different. Coins are like the underlying, they're like embedded with the cryptocurrency that they're associated with. So for example, ETH is embedded with Ethereum. BTC is embedded within Bitcoin. But tokens, on the other hand, can be a smart contract that exists on perhaps even multiple currencies. For example, you could have an you could have like a token, a smart token, or a token that exists as a smart contract on Ethereum, but also on another, say on the Binance, smart contract system, right? And the first one is more like a currency. The second one is more like a stock. If that makes sense. Which is why like tokens can be sort of problematic when it comes to SEC's like viewing of it as if it thinks of it as a security instead of a cryptocurrency, which we'll get to in a sec. But anyways, yeah, usually when it comes to distributing coins, there's like 4 main methods. The first one is just like the public sale, pretty obvious. Anyone who wants to participate can like buy it. There's also community allocation, which is just there's ecosystem funding. It goes back to the community, and then as well as there's insiders who have like vested interests in the success of the company, and so they get a lot of the shares sometimes. And then there's also foundation, which is just grant pools and other rewards for people who participated. And there's also vesting. So vesting is pretty interesting. It's the idea that you lock and also release tokens as time goes on, right? If there's too many tokens that are in circulation and you release too quickly, then the value can depreciate really quickly. And so it's really important to look at the vesting schedule. So for example, here, this is the projected vesting schedule of Algorand. And you can see how some of it goes to foundation, other goes to ecosystem support, and then others go to early backers and so on and so forth. And so you got to really pay attention to these vesting schedules. And sometimes if the vesting is such that a lot of the power goes to the initial early backers or like the investors, the VCs, or the original like team who created this token, if too many people if that controls a huge percentage of the overall circulation, then that means that they might do things that like could be not to your advantage as just a regular person who's investing in the coin. And so you got to look out for those kind of things. So yeah, usually vested tokens are offered to like advisors, partners, team members, and etc. The whole point is that you look at this sort of timeline of who gets what and pay attention to whether it's in your best interest or not. And then obviously there comes utility. So when it comes to a coin, there's security coins, stable coins, and governance tokens. These kind of all represent different use cases of tokens. There's actually other ones out there, but these are like very standard ones. And so taking into account the utility of the token, whether it's for like voting on changes based on the protocol, or as a currency in the case of stable coins, or as a security token, so like representing different assets, underlying assets on the blockchain. Like those are something that is very important to take into consideration when you're trying to invest in a coin. Basically, what problem does this coin solve? And so an important thing is that you don't invest solely based on tokenomics. So this was a few years ago, but this was a very important thing that like Telegram, who was in control of this coin called TON, it didn't want to publicly list on the on the stock exchange because that requires a lot of paperwork. It's very expensive for a company as small as Telegram, and as a result, they decided to issue their own token. So not cryptocurrency, but token, a token called TON. And the idea was that it would sort of almost track the, whether Telegram was doing well or not doing well financially. And this kind of gets into problems when we talk about FTX and the FTT token, or FTT because T stands for token. But anyways, yeah, you can see that like even if Telegram had a very solid, robust token with a very like good tokenomics behind it, if the token stands to have really high risk of it being regulated by regulators as a security, then for example, in this case, it actually got completely dissolved. Like it wasn't, they had to pay an SEC fine, but also they just had to just pretty much remove the currency altogether, or the token altogether. There's a difference. And so if you want, there's this Coinbase project called the Crypto Rating Council, which gives a regulatory risk for every single major cryptocurrency out there on a 1 to 5 scale, so 5 being the highest risk. So again, it's very important that tokenomics is not the only thing that you look at. You also have to look at things like, regulatory risk and stuff like that, which I think Isabel also covered at the very beginning. So this is a fun case study. The real like big problem that FTX's bankruptcy, like when it started, was when there was a leak on November 2nd on a report by CoinDesk of a leaked Alameda research balance sheet. And if you look at the Alameda balance sheet, it includes $3.66 billion worth of unlocked FTT, as well as $2.16 billion of FTT collateral. And if you look at the market cap of FTT was only $3.33 billion. And so, I mean, that's a huge problem, right? Because that means that most of the collateral for loans that Alameda had were in this token. And even if they could sell all of it, which obviously, I mean, you do the math, right? You can't. The coin would just crash to zero, and basically they were insolvent. It was really bad news when investors found out that 1/3 of Alameda's assets were tied up in FTX's token. And so when you look at these tokenomics and stuff like that, when you look at these at this data, it can explain a lot of the reasons why investors freaked out about this, why it was immediately apparent to a lot of people why this was really bad news, and also kind of a reason why the CEO of Binance, Changpeng Zhao, immediately liquidated his FTT position, which is that he knew that FTX was in huge trouble. And so that's pretty much it for today. So thank you for listening. So we'll have a short quiz after this, and that's it. Thank you, everyone.